We did see stocks finally snap a 4-day win streak. Joining us now, Meera Pandit, global market strategist at JPMorgan Asset Management. We had one of your technical guys on yesterday. Horrible. 3,500 was his prediction. You're not there, but you certainly think we've gotten a lot of next year's returns already in where the averages are right now. Because it's not going to be great next year in terms of earnings and in terms of other things, and we've already had huge gains, so valuations are high, I think you think.
The theme for next year is tempering expectations in 2024. I do think overall we have a pretty benign outlook for the economy itself, but when you've had a 20% rally this year, when you've had elevated valuations, and when earnings expectations for next year are in the double digits, when we can probably achieve something about half of that, just given what we heard in the third quarter from CEOs, gloomy outlook. Remember that disinflation helps markets and margins. It doesn't help revenue. So we worry a little bit on the revenue side as to what companies can produce. So if you put all of that together, we need to be a little bit less optimistic, I think, than many in the marketplace are right now about next year, especially because what we've seen in November is very much a sentiment rally, not a fundamentals rally. It's been driven by multiples. We've seen a collapse in bearishness if you look at the AAII investor sentiment survey. So I think people are getting a little bit exuberant about finally having some relief from the Fed, but we have to think about what that actually means next year.
24 was supposed to be the year where we return to double-digit growth. You're convinced with what we heard in the third quarter from the outlooks that these guys aren't just being conservative. You know, a lot of times they talk down expectations so they can beat expectations. You think we can now say with some probability that it's only single-digit earnings returns next year?
I think that's fair because also the big focus this year was margins, and we saw a lot of margin stability. But I do think at this point the pricing power has been exhausted. Luckily, that comes at a time where we're seeing decelerated wage growth, decelerated input costs. But I do worry about when we pair this with some of the headwinds with the consumers, what does happen on the revenue side? I mean, if we look at the Atlanta Fed's GDP tracker, last quarter realized we had over 5% growth, but we're slowing to about 1.2%. So as the economy normalizes, as the consumer becomes a bit more judicious, as companies even say, maybe I need to cut prices a little bit to bring people in just to support those revenues, I'm not sure that double digits is realistic.
So we've had margin expansion, multiple expansion. You noted that already. There's no more of that coming, so we can just purely use your earnings per share number for what the stock market is likely to return. So you're talking about 5% for a stock market return?
I think that's a reasonable outlook for next year, again, with a pretty benign going back to normal type of economy for the economy itself next year. In 2024, we see a 2024 economy. So 2% growth, 0 recessions, 2% inflation and 4% unemployment. So, again, a relatively benign outlook. But again, after such a strong year,
right.
It's just hard to see.
But why
much.
would anyone buy stocks rather than a 2-year? You can get 5%, close to it. So if you can get that risk-free, why even? Because you can't guarantee me that the market's not going to be down 10% next year.
No, I can't. And I think having a little bit of balance is important because if any year were to be down 10%, coming into this year, we would have thought probably this one. We had expectations across the board for negative returns, and we got up 20. So I think we need to be prepared in portfolios for the upside risk. We always undersell what could potentially be upside risk. So we want to still hold on to those risk assets for that reason. But there's no reason not to have short duration fixed income 2-3 years out on the curve because you're getting good income. We don't quite know exactly what's going to happen next year. If we have more of a soft landing, that would actually advocate for shorter duration fixed income. We still want to own some duration because of months like November, where we have the best month since 1985 for the U.S. ag. That was what we were expecting at some point to see, not all in 1 month, but to see some sort of pullback in yields. We've seen that now. I think there's maybe a little bit limited scope for yields to come down that much from here. So having a mix of risk assets, if we have a benign economic outlook next year, and some shorter fixed income is important.
Well, let's say you were in charge, Meera. You're a strategist, global market strategist. It sounds to me, could you see telling people to have 20% stocks, 80% fixed income next year? Would you do that if you could dictate the firm's investment policy?
No, I think the opportunity cost of holding that much cash is extreme.
No, not cash, fixed income.
Well, even on the
how much
fixed income
stock
side.
then? But then what would you do? What would your equity allocation be for the next year?
I think we don't want to stray too far from strategic here, still having that 60% roughly equities, 40% bonds.
You just said 5% if you're lucky, and maybe down 10. Why not get 5% in a 2-year?
Well, I think that's the balance within portfolios. We don't want to give up the upside within the equities. We know that there's potential equity there. Yeah. Well, I still think of a 5 to 6% gain in the equity market.
With dividends, maybe?
Is long-term what you would expect when you're setting up a portfolio. We've gotten so lulled into 10% returns, double-digit returns. That's just unrealistic in the rate environment we're heading into.
But it's possible.
It's possible, and we've seen, again, that the majority of the time since the financial crisis. But I don't think that we want to count on those types of returns. The upside risk is there. We still want to be invested in order to get some of that upside risk. I think we have to have more realistic expectations around what the equity market can do. But also, if we start to see yields come down a little bit more, we have to be a little bit concerned about banking on the income. And I think that's what people have really done in cash.
And you could actually try to buy some good stocks. You don't just have to accept 5 or 6% like the averages. You
right, and that is the average.
You can try to pick, try to pick some good stocks. Watch CNBC.
If we think about the quality that is still out there in the U.S. market, certainly there are many opportunities. It's going to be very much a bottoms-up analysis in terms of which stocks we like and where we're finding opportunities. But I don't think we should count out the stock market next year. Just don't expect a repeat of 2023.